Today, I'm talking about things that agencies need to consider before exchanging services for equity in a startup. Hi, I'm Kyle Racki, and today I'm talking about exchanging services for equity in a startup. So when I ran an agency about 5 years ago, this happened on a number of occasions where a client would come to me and say, hey, we want you to build our product or our app, and instead of paying you in exchange, you can have shares in our company and you can be a co-owner in the company. Now, this question came up recently on Facebook from a digital agency owner kind of asking what she should do, and I just wanted to offer my 2 cents on it. So first of all, I want to get the ugly truth out of the way, which is that this is almost always a bad idea. Everybody out there has an idea for a product or an app or the next Facebook killer, and so few of those are actually ever going to succeed and become a big thing. So if you take on every client that comes to you that wants you to build their app for free, just know that most of them are going to fail. And really good entrepreneurs really value their shares. They know that owning shares in their company is a valuable thing and that it's going to be worth a lot. So if a client comes to you and they're a little too quick to offer up shares to you, maybe they're not the real deal, and maybe you're going to end up losing a lot of time and money on this. So even if you are considering taking shares in a startup and giving away your services, at least at a discounted rate, there are a few things that you really need to consider. And one is look at what the true cost of what you're delivering is. It's easy to kind of guess and put an estimate on the number of hours it's going to take maybe your developer to build the product. And let's say you think it's going to take 200 hours, you times that by your hourly rate, and that's what you come up with as the value of what you're offering. But there's a lot of other things that will come up, such as project management, bug testing. What happens if the project just takes too long? What if the client asks for more? You have to really put a number on what all those add-ons are going to be and how you're going to deal with them when the time comes. Because if your client is expecting that they're just going to get carte blanche, unlimited services for the next couple of years, you're going to end up losing a lot more money on that. You're going to end up investing a lot more in that startup than what you might have first thought. Other things to think about is the opportunity cost to your business. When you're working on one thing, it means you're not working on another thing. So if you're doing all this free work for this startup or all this discounted work for a startup, it means you're not working on maybe billable projects that are bringing revenue into your agency. The other thing to think about is, do you have the cash flow to support this? If you're already running on razor-thin profit margins, you might just not have the time and money to take this project on. One of the most important factors in making an investment in a startup is who the founding team is. Do they have a proven track of success? Have they come from another business before where they've maybe got acquired or built proven that they can build a team and generate demand? That they're not just somebody with an idea. That's not really who you want to invest in. And I would put my money on, the worst idea with the best founder versus the opposite, the best idea with the worst founder or somebody who just doesn't have the track record. I mean, building a startup is extremely hard. I liken it to trying to build a fire with wet wood. It takes grinding and just years of success, or rather years of effort to take off. And you don't want somebody who's going to give up as soon as it gets hard. And that's really what you want to look for in a founder, somebody who's got the tenacity to keep going when things are tough. So the second thing you want to consider when investing in a startup is what problem are they solving? Would you use this product yourself? Do you feel this pain yourself? If it's something that you can't really understand why anybody would need, it's probably not worth going after. You also want to think about the market size and the opportunity within that market. It doesn't mean that the product can't have a niche or be very specialized, but would it have the opportunity to grow and expand later on? For example, when I started Proposify, a lot of investors thought that it was way too specialized and too niche, going after agencies and being just proposal writing. But what a lot of them didn't realize is that it was actually part of a much bigger market within software as a service called sales enablement, which had cost price quote and e-signatures, and those markets are growing extremely quickly. So even though you might start off niche, is there an opportunity to grow and expand later on? And the other thing that I would look at is what's the business model? Because a lot of people with, especially first-time founders, want to try to make the next social network like Facebook or Instagram, or they want to create the next two-sided marketplace like Airbnb and Uber. But what they don't realize is that those are extremely difficult business models to make work. You need to raise a lot of money before you ever start generating revenue. And a lot of them try to switch way too late into software as a service because that's an easier business model to execute. You give people a product that they need and they pay every month or every year to use it. It's such a simpler way to make money and to be able to grow and expand later on. So, look at that aspect as well. So let's say you've looked at all these things and you decide, yes, I want to invest my people's time, my agency's time into building this software product with somebody else. The next thing that I would look at is what's the mechanics of the deal? How is that looking? Because a lot of times when you're taking shares out of a business, you want that to be part of a bigger round of funding. So maybe there's other angel investors that are coming to the table and putting cash into the business. And what you as the agency are putting in is time. And so you want that to be kind of part of a bigger round of funding, especially where there's legal stuff that is going on during this fundraise. And you want to be looking at, are you supposed to pay for legal? Normally the startup founder would be paying for that. So you would want to look at that. You'd also want to look at how clean is this deal? What's the cap table look like? All the people that own shares on this. Is this the second or third round of funding? Hopefully not. Hopefully it's very clean. The intellectual property is cleanly in a separate corporation. So there's a lot of legal stuff that you want to look at and maybe have your lawyer look at to make sure that you're not getting involved in a really messy deal where maybe the IP resides in some, the client's other business and there could be potential lawsuits down the road. The next thing you're going to want to look at is what's the exit potential of this company. If you own shares in the business, ideally one day you want them to be worth a lot more, and there's nothing you can really put in writing that can guarantee that you're going to be able to exit from this thing. So you have to be able to believe in the founder's ability to grow the business, because if it's generating revenue, if it's growing its customer base, then very likely somebody will come along one day and acquire it, or they're going to be able to raise additional rounds of funding. Now, there's a word of caution there, which is that if the founders do plan to raise VC money down the road, you as an early stage investor might get diluted and really not own a lot of this business anymore. And especially where VCs often take what's called preferred shares, which means that down the road, if the company gets acquired, and let's say it gets acquired for less than the last round was worth, then the VCs make out with all of the money, and the founders and the first investors are left with nothing. So you're going to want to think about that. And that's why waiting for an acquisition might not be the best thing. You might want to wait for that next big round of funding to be able to take your shares and sell them to those VCs so that you can come away with a nice clean exit, a nice, maybe 10x return on whatever those shares were worth when you originally invested in the company. Now, you might think, what about if instead of taking shares in the business, I just take a percentage of their revenue, or that I take dividends out of the business? Now, dividends actually makes a lot of sense. If the company can generate a lot of cash and they don't really plan to exit down the road, it's a nice way to be able to recoup your investment, have multiple streams of income. The percentage of sales is not something I've ever heard of really working out that well. It's a bad deal for the founders if they have to give away a percentage of their sales to you every month for the next 10 years. So if you can work that deal out, fine. But, chances are if the company actually takes off and starts making money, they're going to try to change that, and try to work a better deal out for themselves. The final thing to think about is, how are you going to keep adding value to this company? You're an owner now. You own shares in this business. So it's easy when you're an agency or a service provider to think in transactional terms, billable hours. But if it's your investment, you want to protect it. So you're going to have to offer some strategic guidance. You're going to have to find ways to, create value for the founders and for the company as time goes on, and not think of everything in terms of a transaction. Now, that doesn't mean you have to do a lot of free coding or a lot of free marketing work for them, but you should be there to answer questions and not charging them a consulting fee. And you'll have to think about succession planning when it comes to how do you hand over the code base now to their in-house developers, and be able to make time for that, so that whatever you've built in your agency, you can now hand off and give to another team to take and run with. Investing is a great way to build your wealth profile, and investing in startups is a riskier way to do that, but still something that's worth considering. So if you are an agency thinking about investing, I hope this episode has been helpful. And this is Lifetime Value with Kyle Racki. Thanks so much for stopping by.
This episode of Lifetime Value is brought to you by Proposify. Proposify improves sales productivity so your team spends less time creating proposals and more time selling. Start your free trial at proposify.com and be sure to hit the subscribe button so you never miss a single episode.